2020 has undoubtedly been one of the most difficult years to navigate as an investor. And I think that one could pretty easily make the argument that it was the most challenging year to navigate since the Great Depression. Investors were faced with high levels of unpredictability in financial markets due to the economic fallout caused by the global COVID-19 pandemic. We saw central banks and governments take drastic actions to bail out their domestic economies. We saw social unrest take the world by storm, with countless protests and riots happening not only within the United States, but in other developed countries all around the world. And all of this happened during an election year, which historically leads to more volatility in financial markets due to the unpredictability that comes with a new administration. And although the stock market has made a remarkable recovery since the lows of March, we have seen the stock market stagnate since August, with the S&P and Nasdaq bouncing up and down and not really making any significant gains. With that, a lot of investors are wondering where they should be allocating their capital in order to maximize their potential upside and minimize their downside risk. That's what we're going to be covering in today's video, so let's not waste any time and let's get right into it. Prior to COVID-19, a lot of investors were fearing that we would be soon entering another recession. We saw the Federal Reserve lose control of the repo market in 2019. We saw credit markets start to tighten up with the Federal Reserve slowly raising interest rates. We saw trade tensions between US and China affect the US economy. And we saw the yield curve invert twice since 2018. But I don't think any investor was expecting the recession that we got, which was caused by COVID-19. COVID-19 caused a recession the likes of which we have never seen before. We saw US GDP fall by 33% in the second quarter of 2020, and this is because COVID-19 led to both supply and demand shocks in the US economy. The demand shocks were caused by the fact that businesses were forced to shut down, therefore employees no longer had wages, which affected their ability to spend and caused a dramatic drop in economic activity. And the supply shocks came from the fact that employees were mandated to stay at home, so companies were no longer able to manufacture their goods. This led to the creation of a lot of holes within the US economy. And it was these holes that the US government and Federal Reserve seeked to fill through their stimulus and money printing abilities. Now, in early March, there was a very significant liquidity crunch happening in financial markets. And this is because COVID-19 led to an incredibly high amount of unpredictability in financial markets. Back in March, we didn't really know what effect COVID-19 was going to have on the economy, but the general consensus was that it was not going to be good. And investors are very frightful creatures. When they feel that there is very high unpredictability, they draw their money out of financial markets as fast as they can, and they don't really care about what asset class they're taking their money out of. All they know is that there's probably going to be a liquidity crunch, so they try to get their money out of financial markets as quick as possible. And this is what we saw in early March, as the stock market, bond market, everything just crashed, as generally when liquidity crunches happen in an economy, the correlation of asset classes nears 1. Now, the Federal Reserve and US government knew that this was going to happen, and they wanted to dull the effect of COVID-19 by providing liquidity to financial markets. Now, the US government focused on the consumer and business side and provided loans to businesses and stimulus to individual consumers. And the Federal Reserve focused on financial markets by providing liquidity, by lowering interest rates, and conducting quantitative easing. Now, this led to extremely high levels of liquidity in financial markets, which is why we have seen the stock market recover so rapidly. But faced with so much liquidity, investors faced the challenge of allocating that capital efficiently. And what we saw was that a lot of capital was allocated to high growth tech stocks, while retail and industrial stocks didn't see that much capital allocation come their way. And we can see this relationship pretty clearly if we take a look at the Nasdaq, S&P 500, and Dow Jones Industrial Index. We can see that since March, Nasdaq has performed the best out of the three indexes by quite a large margin. What this tells us is that there was a greater allocation of capital towards high growth tech stocks and not so much capital allocated towards industrial and retail stocks. And this has created an opportunity for investors in 2021. Because capital was allocated inefficiently for a long-term perspective, because investors were only able to focus on the short run since there was so much unpredictability regarding COVID-19 in the early months. Now, just to get an idea of the scale of the problem that investors faced, having to allocate all of that additional liquidity provided by the Federal Reserve, let's take a look at the increase in the money supply in the United States. We're going to take a look at the M2 money supply, which is a broad definition of money within the United States, and we see that the US M2 money supply increased from 15 trillion to 18 trillion in under 1 year. This is a 20% increase in the supply of money within the US economy, and is a larger increase in the supply of money than we've ever seen before in the history of the US economy. And this is a cause for concern but it's a problem for the future because the markets really did need all of that additional liquidity in order to fight off what could have been a pretty deep depression. So with $3 trillion of money being created in the US economy, investors had to allocate that capital to what they thought was the most efficient allocation for the information that they had at the time. And the information that they had at the time regarding COVID-19 wasn't that great. So what they did was they allocated their capital to a lot of high growth tech stocks, and predominantly large cap growth and mid cap growth stocks is where we saw the most money allocated to. But what I think is going to be the best market opportunity for the year 2021 is to be shifting your capital away from large and mid cap growth stocks to small and mid cap value stocks. And that is because a lot of these small and mid cap value stocks are currently being mispriced by the market, and I believe that we're going to be seeing a lot of this excess capital rotating away from the large cap growth stocks where investors have made a lot of profits and into small and mid cap value stocks. So that is what I think is going to be presenting the best market opportunity in the year 2021. And now this is actually the strategy I've been pursuing in 2020, as I thought that the best stocks to be buying were value stocks, because value stocks historically experience less volatility than growth stocks. Now, while I have missed out on some of the exceptional market gains that other market participants have seen who are buying growth stocks, I think that I am very well positioned for the future in 2021, as we are already starting to see a rotation of capital out of the large cap tech stocks and into more value-based stocks. Now, I even made a prediction in one of my last videos after Apple's stock split, where I said that I thought that Apple stock is going to be performing pretty poorly after their stock split because investors are going to be cashing in on their profits in Apple stock and shifting their capital away from Apple and into more value-based stocks. And that's exactly what we've seen in the last few months, as Apple stock has fallen since their stock split and has not yet made a recovery. On top of that, other stocks that I recommended in my past videos, like the Gap, have been performing extremely well. Now, of course, there's a lot of other considerations you need to have in terms of building your portfolio, and I'm not saying that pursuing small and mid-cap value stocks is the right strategy for everybody. But that is the strategy that I'm going to be pursuing because I believe we're going to be seeing a lot of this excess capital, which was inefficiently allocated in the aftermath of COVID-19, and we're going to be moving away from the inefficient allocation of that capital to a more efficient allocation as we see a lot of capital rotate out of those large cap growth stocks and into small cap value stocks. Now, on top of the fact that I think that this is going to be a good strategy for 2021, it's also a great strategy for any long-term investor. Now, if we take a look at this chart, we can see that small and mid-cap value stocks perform the best out of any asset class in the stock market, and it outperformed that of mid and large cap growth stocks by over 4,000% and 2,000% respectively since the 1970s. So having an allocation to small and mid-cap value stocks is definitely a good long-term investment strategy, and it is one that I am currently pursuing. On top of that, value stocks historically experience less volatility, so you'll be able to withstand market downturns a lot better than if you have exposure to large and mid-cap growth stocks. This is all to say that I think that the best opportunity for 2021 is to be investing in small and mid-cap value stocks. So that does it for this video. As always, I'm not a financial advisor, but I do hope that you enjoyed this video and learned something new, and I look forward to seeing you all in my next video. Have a great week.